We've got a full house here on set to talk about it. Joining us now, Unlimited CEO Bob Elliott and Bleakley Financial Group CIO Peter Boockvar. Welcome to you both. Where to start? Peter, I'll start with you. Right now, stocks trading at the levels they are. I mean, we've had such a rip-roaring start to the year. The fact that we're in this narrow range and have been for the better part of a couple weeks, a couple of months, where do we go from here?
I think on one hand, stock investors don't want to miss the Fed is done rally. And they're sensing the Fed is just about done. Yes, we're pricing in about a 50-50 chance of another hike by the end of the year. But I think a lot of the basis for the rally, it goes back to the bottom in October and the top on the dollar was, I can't miss the Fed is done rally. So I think after digesting Q2 earnings, which at the end of the day, you had this big rally in tech that was neutered essentially when actual earnings came out. I think we have to deal with, yeah, maybe the Fed's done, but that doesn't mean rates are all of a sudden going to drop. And this rise in long-term interest rates, I think, caught a lot of people by surprise. Because we had some complacency. Inflation's dropping. Fed's almost done. Oh, boy, the 10-year yield's all of a sudden 4.25. So that creates not only a hurdle for stocks, but also another hurdle for the economy because it's a realization and a reinforcement that we're in a different interest rate world here. And we better get used to it. And it's going to clip away at a lot of different companies that have debt coming due as the weeks, months, and quarters progress from here. Yeah, higher for longer. And the Fed and Fed officials have continued to hammer the point home for so long now that it would take quite a lot for them to start thinking about cutting. You're short tech right now, right?
Yeah, I mean, I think, tech stocks and the valuations that we've seen are pretty extreme and very reliant on that bounce from an expectation that the Fed was going to pull back. And the reality is each day that comes in, we get incremental new information that suggests that, the Fed still has a lot more work to do, whether it's in wages, whether it's in underlying inflation, even, many of the macro stats continue to be good enough to keep the Fed on pause, at least for a very long time, if not tightening more. And so you put that together and that liquidity expectation, that world of, lower interest rates, that's not going to be realized, particularly as was mentioned on the long end, seeing the pressure there.
Okay, so Bob, you're short tech. Peter, you're wary of how shaky the premium consumer is and how much that's been holding things up in the economy. Apple has a big announcement next week, and it's tech that appeals to the premium consumer. I know Mike Santoli just said there's no trend in trading around Apple announcements, but 4 out of the past 5 weeks after an iPhone announcement, the stock has sold off. So who would be negative on Apple for next week? Which of you? Either of you? Okay, Peter, why? Because of the premium consumer concerns and the China stuff?
Well, valuation, people delaying the upgrade to a new phone. I use my son as an example. Like, when does he want a new Apple phone? And he hasn't asked that question in a while. So him and all his friends, there's no excitement to upgrade. They're happy with their existing phone. And then, of course, you throw in the China thing. But the valuation is, when you have a high valuation, there's no room for error. There's no room for error when earnings don't grow. There's no room for error when 20% of your business is now at risk. There's no room for error. And I think that the excitement that Apple tries to generate is losing some of its effectiveness because people just don't feel like, again, the need to upgrade their phones.
And big tech has been big for the entire market. So I wonder, Bob, are we in a bit of a boy who cried wolf situation with the overall markets, except it's boy who cried recession? A lot of people forget at the end of the story, the wolf actually comes and eats the boy, right? Because nobody believed it was coming.
This just got dark.
Is it going to get dark? Literally for the markets, because not everybody's believing in a soft landing, but we have this setup.
Well, I think that's such a great point that, the probabilities of recession over the course of the next, 3, 6, 9, 12 months have risen considerably over the course of 2023. Just at the same time, everyone has given up on recession. And so you go back to that overall market dynamic, you're looking at 12% earnings growth priced into 2024, right at a time when you're getting that pressure on the long end, at a time when, while the labor market is tight, we are starting to see those cracks at a time when Geopolitical tensions are clearly emerging for some of the high-flying stocks. You put that all together, it's going to be pretty tough it would have been tough to achieve 12% earnings growth with no other issues, and maybe even the Fed easing. Think about it in the context of a Fed continuing to be tight, geopolitical tensions, the consumer demand is slowing down. Like, that combination of things is pretty tough to achieve those lofty expectations.